Welcome back. In the last lecture, I introduced the concept of interest rate risk, and we discussed various measures of interest rate risk. We talked about the dollar value per basis point, we talked about duration convexity, and we talked about the interest rate elasticity. Let us recap a bit before we move forward. On the slide, you can see the relationship between the YTM and the bond price. There is an inverse relationship which is also indicated by the negative slope or the negative first derivative of the price with respect to the YTM. As you can see that the curve is downward sloping. Increase in YTM indicates a reduction in price. The second feature which is more important is the positiveness of the second derivative, which shows the existence of a curvature, which shows that the relationship is not linear. Which shows that the relationship is not linear. There is a curvature effect attached to it, which is captured by the second derivative. Of course, there will be other terms when you do the Taylor expansion, but for practical purposes we confine ourselves to the first and the second derivative terms, first and second order terms. The second order term is called the curvature term, and which is given a name by and is termed the convexity of the bond price with respect to the YTM. Of course, every bond will have its own value of convexity depending on the structure of cash flows. So, the implication of this curvature is that if I use duration for arriving at a particular percentage change in price, if I confine myself to the use of the first order term, that is this linear approximation, the error that arises between the actual percentage change in price and the price that we work out on the basis of duration is going to increase with the level of convexity. Higher the convexity of the bond, greater is going to be the error due to the negligence of the second order and higher order terms. Then we talked about an example where we illustrated what I mentioned just now. There was a bond for which we worked out the duration, it worked out to 3.92 years. We worked out the convexity also, which worked out to 10.78 years squared. Then we worked out the changes in price using simply the duration corresponding to a change in YTM corresponding to a yield shift of 7%. The percentage change in price using only duration was 23.28%. The convexity correction was 3.79%. They operate in opposite directions. Please note that. Why? Because the first derivative is negative, the second derivative is positive. If you combine the two, you find that the net change in price as a percentage is given by minus 19.48%. The actual change in price works out to minus 19.93%. So, the approximation is much better when you incorporate the convexity correction. This is a recap of the various formulas. The dV01, that is the dollar value per basis point, that is simply the negative derivative of the price with respect to the YTM. We have the duration and the modified duration as well, which is related to the Macauliffe duration by this expression Dmac upon 1 plus y naught, where y naught is the point at which we are working, which we are incorporating. Now, then we talked about the interest rate elasticity is given by this expression. Then we talked about a very important concept called immunization. I emphasize the fact that if I am invested in a bond portfolio, the longer is the maturity of the bond, for example, or let us say the longer is my holding period of the bond. If there is a higher upward shift in the interest rates, the benefit that I am going to get from the reinvestment of coupon payments, the intermediate coupons that I am going to get will increase. In other words, the cash flow that I am going to derive, at the end of the holding period, this is my holding period capital T, this is 0, this is the life of the bond. the cash flows that I am going to derive up to the holding end of the holding period capital T will increase due to the reinvestment effect if the interest rates increase. If the market interest rates increase, I will be able to invest the coupons at a higher rate, and therefore, my total cash flows at time T will increase. But when I go to the market and sell the bond, because I am not holding the bond to maturity. So, when I sell the bond at time T, the price that I will get in the market will be reduced. Why? Because the discounting factor for this region, that is from T to the life of, to the end of the life of the bond, to the maturity of the bond, and therefore, the cash flows that the present value of cash flows that I get at this point are going to reduce, and as a result of which the price is going to fall. To reiterate, if the interest rates increase, the discount factor will decrease, because they are inversely related again, and therefore, when I discount the future cash flows from T to N, bringing them back to capital T to my holding period, that will fall, the value of that amount will fall, and therefore, the market price will also fall. So, an upward jump, an upward kink in the interest rates would be accompanied by two counteracting effects. The reinvestment effect will enhance my cash flows at T, whereas the capital profit or the capital loss that I will get by selling the bond in the market is going to decrease. Now, these two effects are not uniform throughout the entire period 0 to n. In other words, what I am trying to say is the reinvestment effect and the capital gain effect tend to depend on the holding period for which I am going to remain invested in the bond. Longer my holding period, greater is going to be the reinvestment effect, and smaller is going to be the capital impact or the impact on the price due to a change in the interest rates. On the other hand, if I hold the bond for a shorter period, there would be greater coupons being discounted, there would be greater number of coupons being discounted, and therefore, the impact of an interest rate on the market price would be magnified, whereas the reinvestment effect would get less time to come into prominence. There is one particular point in this time span 0 to n at which if you remain invested, these two effects actually counterbalance each other, and that time period turns out to be, if you do the analysis, that time period turns out to be equal to the duration as has been defined in the earlier slides. So, that is a very important implication of the concept of duration. Duration is that time period such that if you remain invested in that time period corresponding to a particular pattern of cash flows of a bond, then you become protected against a change in the interest rate. But please, I reiterate once again that protection is for very small changes in interest rate. It does not it is not a blanket protection, because duration is a linear approximation that has to be kept in mind. To provide an example of what again I have explained, just look at this set of figures. The YTM at which the duration works out to 7 years, which I have taken as my holding period. If you look at this, there are two things which are very clear. If the YTM changes between 16 and 17%, please note that the duration the YTM corresponding to a duration of 7 years or the other way around is 16.65%. But the important thing is, if my YTM fluctuates around this particular figure of YTM 16.65%, say it moves slightly upwards or slightly downwards, the change on the total cash flows is very small. It is hardly 1 unit of money, slightly more than 1 unit of money. Contrast this with any other two figures, let us say 11 and 12%, the change is 41 units. So, that is the magnitude of the difference between a fluctuation of the same YTM. YTM change is only 1% in both the cases. Here also it is 1%, here also it is 1%. But look at the change in the total cash flows, 41 against 1. And the second thing is, the total cash flows at this particular point turn out to be minimum of all, which you can again observe from this set of data. Okay, let us now come to, having talked about what we have done in the previous class, let us now come to what we are going to discuss now. Today we are going to talk about interest rate futures. In particular, we are going to focus on T-bill futures. What are interest rate futures? Well, futures on commodities we have talked about, futures on currencies we have talked about, futures on stock indices we have talked about. Futures are defined in terms of the underlying assets. So, when we talk about interest rate futures, the underlying asset of an interest rate future is an interest bearing instrument. It can be a treasury bill, it can be a deposit, it can be a treasury bond, it can be some similar thing which bears a fixed income, which is an interest bearing asset. So, interest rate futures are a particular example of interest rate derivatives. The common interest rate futures, of course, there are innumerable interest rate futures trading across the world, but the ones that we are going to talk about in this particular set of lectures is the treasury bill futures, the euro dollars futures. I will give a brief touch up on that, and then we will also talk about the T bond futures. Now, these have long term instruments. These have long term treasury bonds as the underlying instruments. These have short term T bills as the underlying instrument, and these are short term deposits on which futures contracts are written. To reiterate, these are futures on which the underlying instrument is the T bill. Here the futures are on euro dollars, which are short term dollar deposits, and here the underlying instruments are treasury bonds, which are long term instruments issued by the government. A brief touch up on the NSE 91-day T-bill futures, which are traded on the National Stock Exchange in India. The underlying asset, as I mentioned just now, 91-day Government of India Treasury bill. The trading unit, that is the lot size, 2000 units, the face value of each unit is 100 rupees. So, the face value of the entire contract comes out to be 0.2 million or 2 lakh rupees. The tick size, that is the minimum fluctuation that is allowed by the exchange in terms of which quotations can be placed, is 0.0025. The contract trading cycle, well, there are 3 serial monthly contracts, 3 serial monthly contracts, and then followed by 1 quarterly contract. So, 3 serial monthly contracts, 3 monthly contracts, and then we have a quarterly contract. Price quotation, now this is interesting. The method of quoting of the price is similar to what we have for the treasury bills, which is the underlying instrument. It is given by 100 minus y of the particular f, where f is the futures discount yield. F is the futures discount yield, not the discount yield on the underlying instrument, is the discount yield on the futures contract. I will come back to it in a minute, but price quotation is given by 100 minus YF, where YF is the futures discount yield worked out on the basis of the futures contract, not on the basis of the spot, the underlying T bill. The contract value, because each contract has a lot size of 2000, so you multiply this by 2000, you get the value of the contract, 2000 into 100 minus 0.2. Now, from where does 0.25 come up? 0.25 comes up from the fact that it is a 91 T bill, and which is the underlying instrument. It is approximated to 90 days, and that is how the value of the contract is calculated. 2000 into 100 minus 0.25, this is the annual rate, YF is the annual rate, and quotations are made on the basis of a 90 upon 360 convention, and therefore, we have 100 minus 0.25 into YF, 90 days on an year of 360 days. Settlement is the daily settlement is based on 100 minus 0.25 YW, where YW is the weighted average discount yield worked out on the basis of the last 5 trades occurring in the last half hour. If the trades that are occurring in the last half hour, subject to a minimum of 5 trades, and if 5 trades do not take place in the last half hour, we take the 1 hour interval, take the average over 1 hour, provided 5 trades are at least there, and if that also does not happen, we take an average over the last 2 hours of trading, provided that 5 trades are again available for working out the average, and the average is volume weighted. So, this YW is the volume weighted average of the number of trades occurring in the last half hour, subject to a minimum of 5 trades, otherwise the time interval goes on increasing. So, the daily contract settlement price, you multiply this by 2000, you get the daily contract settlement price, because the lot size is 2000. The final contract settlement price is worked out in terms of YF. YF is the yield determined on the basis of the weekly auction by RBI of Treasury bills, and this YF, in other words, we are now again equating the futures yield to the spot yield on the date of maturity of the contract. The spot yield is determined by the average yield on the weekly auction of Treasury bills by the RBI, and the settlement is in cash. Now, let me just read it out as far as this daily settlement yield is concerned. The futures yield, it is the volume weighted average futures yield of traded future contracts in the last half hour of trading, 30 minutes of trading, subject to there being at least 5 trades. If there are not 5 trades, then you take the 60-minute period, and again we must have a minimum of 5 trades for working out the average. If it is not there in the last 60 minutes, 5 trades are not there in the last 60 minutes, we extend the time period for working out the average to 2 hours. Final settlement price is worked out on the weighted average discount yield obtained on weekly auction of 91-day T-bills conducted by the RBI on the day of expiry of the futures contract. So, these are technical things just to acquaint you for this. Parallel to this, just to touch upon the US market, in the US case, again we have similar treasury bills just as we have in India, except that in India we have T-bills in terms of the number of days. In US it is more common to have them in the number of weeks or months. So, we have treasury bills with a maturity of 1 month, that is 4 weeks, 3 months, 6 months and 1 year, and they are sold in denominations of US dollar 1000, and the maximum purchase that can be is of 5 million US dollars. Contract specifications are very similar to what we have for the Indian T-bills, except that the contract size here is US dollars 1 million. The unit of trading is US dollars 1 million. In India, we had 0.2 million INR. The method of quotation is again similar, 100 minus y, and the tick size here is given in terms of the interest, which is 0.50 basis point, which translates to US dollars 12.50, because you are having a factor of 90 days investment here. So, a change in interest rate or a change in yield of 0.50 basis point translates to a change in contract value of US dollars 12.50, as can be seen. So, these are some technical details about the US dollars T-bill futures. Let me just touch on one thing. On a given delivery date, there are 3 T-bills which are available for settlement. For a particular, on a given delivery date, there will be 3 types of T-bills which can be used for settlement. The current 3-month T-bill, which has a maturity of 3 months to go, because the delivery has to be made of a T-bill which has 3 months to maturity. So, the current T-bill which has a 3-month maturity pending, or a 6-month T-bill whose 3 months have expired and 3 months are still pending, or a 12-month T-bill whose 9 months have expired and 3 months are pending. In other words, a fresh T-bill with a maturity of 3 months, a T-bill issued 3 months ago with a remaining maturity of 3 months, and a T-bill or a T-bill of 12 months maturity which has been issued 9 months ago and which has 3 months to maturity. And conversely, on a given trade date, for example March, we have 3 futures available for trading. The June delivery futures, now when we talk about the June delivery futures, the delivery must be of a T-bill which has 3 months to maturity. So, as on March, it will have a remaining life of 6 months, March to June, and then June onwards it must have a 3-month maturity period. Similarly, again a bond which has to have a maturity of 3 months, but which has been issued earlier as 12 months earlier or 9 months earlier can also be is also available for trading. Let us see how. So, we have 3 futures contract which can be traded as on March. Bill having a life of 3 months as on March, delivery in June, maturity in September, then a bill which is delivered in September, maturity in December, that is 9 months remaining life as in March, and then a bill that is delivered in December for maturity in March, which has a life of 12 months as on March. So, these are 2 interesting situations. Now, the quoted price, the index price and the traded price. The quoted price, as I mentioned earlier, is given by 100 minus y of f, where f is the futures yield. F is the futures yield. QF is given by 100 minus YF. How do we work out YF? Well, the process is absolutely parallel to the way we work out the spot yield. How do we work out the spot yield? We work out spot yield by P1 minus P0 divided by P1 into 360 upon N. In our case, N will be 90. P1 will be the face value of the bill, and P0 will be the price at which the futures contract or the futures is going to be settled by the delivery of the bill. So, using this expression, we arrive at the traded price or the transaction price as the face value of the bill. This P1 is the face value into YF upon 100. If YF is given in percentage, we divide by 100. If it is given by in decimals, we do not do that. We simply take YF, and 90 upon 360, which is the usual the convention to take the 90 day as the relevant period for working out the quotations and the traded prices, transacted prices. In the case of NSE, for a single contract, instead of face value, we will have the lot size in terms of value. In the case of NSE, as I mentioned earlier, the lot size in terms of value is 2 lakh INR or 0.2 million INR, and in the case of US T-bills, it is 1 million INR. Now, there is one very interesting point. As I mentioned earlier, we use the discount yield for most of the work as far as treasury bills are concerned, and we define the discount yield as y is equal to P1 minus P0 divided by P1 into 360 upon N. And this is how we work out the discount yield. If we use the interest rates, then the interest rates expression would be slightly different. Interest rates would be let us call it R. R is equal to P1 minus P0 upon P0 here into 360 upon N. Now, just to show the relative differences in the prices, if I use one or the other, I worked out a table corresponding to a maturity of 90 days, which is what we have been talking about most of the time. So, a maturity of 90 days, if the rate is 5%, using this yield expression, the first expression, I arrive at a price of 98.75, because this is very clearly 1/4 of this. So, that works out to 1.25. So, 100 minus 1.25 works out to 98.75. But if I use the second one, the interest rate expression, I get 98.76. Similarly, for other interest rates, I get, for example, at an interest rate of 15%, at a yield or interest rate of 15%, the difference begins to become slightly significant. However, this is the market practice, market convention, although we are more accustomed to this, but as far as the market practice is concerned, as far as what we shall be doing in the future in terms of T-bills, we have to confine ourselves to the first example, that is the discount yield. Now, we come to the hedging using interest rate futures. Let us take an example. Let us take a very simple example. Let us say this is t equal to 0. You have taken a long position in an interest rate future, a T-bill future, which what does it mean? First of all, let us understand. If you have taken a long position in a T-bill future, let us say with a delivery date at capital T, then it means that at capital T, you will be receiving a T-bill and you will make the payment for that T-bill. What payment you will make? That payment, normally it would have been decided by the market price prevailing at this date. But under a futures contract, the price that you are going to pay for the T-bill that you are going to receive here is determined at T equal to 0. That is the futures price. The price at which the T-bill will be handed over to you at T equal to capital T is determined at T equal to 0. And the life of this T-bill is going to be 90 days. In other words, after 90 days or whatever that underlying is, 91 days, 92 days or 90 days, whatever it is, after that period you will receive the face value of the T-bill. This is capital N. So, let us say this is capital N. At capital N, you will receive the face value of the T-bill by delivering the T-bill or by an entry into your direct credit into your account, you will receive the face value of the T-bill. So, that is how futures operate. Now, let us see what happens if during this period there is a downward shift in interest rates. If there is a downward shift in interest rates during this period 0 to T, how will it impact the price of the bill at this point? Remember, price and YTM are inversely related. So, if there is a downward shift in market interest rates, the price of the bill at this point is going to go up. The price of the bill at this point is going to go up. But you are already assured of getting this bill at this point at a given price. You are already assured of getting this bill at the given price, which is fixed beforehand, before this interest change occurred, and the price has now increased. Therefore, the value of your futures contract will be a positive value, because you will be getting the bill at a lesser amount compared to what the now market is pricing that particular bill. So, that is how the Treasury bill operates. So, what do we conclude? If there is a downward shift in interest rates, I will be making a profit. If there is a downward shift in interest rates, I will be making a profit if I take a long position in a T-bill future. In other words, what happens? If my cash position is such, that a downward shift in interest rates will result in a loss for my cash position, I can compensate that loss for my cash position by taking a long position in the T-bill future. If there is a downward shift in interest rates and I incur a loss, then I can take a long position in the T-bill and thereby make a profit, and that profit will compensate for the loss that I make on the cash position. So, that is how this T-bill futures operates. Thank you. I will continue after the break.